I've been getting a lot of questions lately about the recent large drop of oil. The questions I'm getting are along the lines of, what do you think is going to happen to the price of gold? And is it safe to buy or hold gold? These are reasonable questions. After all, we can see from this graph of the price of oil compared to the price of gold that the two items track each other very well and have done so for the past 5 or so decades. When we see the ratio of the two prices deviate far from about 18 barrels of oil per ounce of gold, it's usually a good indicator that the price of one or the other is likely to correct so as to bring the ratio closer to 18. So the question now before us is this: with the gold to oil ratio currently standing at about 21, should we be avoiding the holding of gold? Well, in order to answer that question, we need to first ask ourselves what else we should hold instead. The nature of the questions that I've been getting have been in regards to the price of gold, and so the natural assumption that's built into the questions is that one might prefer to hold dollars and wait for the price of gold to correct. I do think that a gold price drop is certainly possible. After all, the natural range of the gold to oil ratio is between 10 and 25. So there is potentially quite a bit of downside possible in gold relative to a dollar holding. There is also the possibility that the price drop in oil will reverse itself as it did starting in 2009. Notice how quickly the price of oil rebounded once it hit its bottom in 2009. The ratio of gold to oil spiked up during the 2008-2009 crisis from a low of 7 barrels per ounce to a high of 22. Yet the investor who bailed out of a gold position and into the dollar at its lows would have watched in dismay as the price of gold more than doubled over the subsequent 2 years. So what we can see is that while the gold to oil ratio is a pretty good indicator of whether or not gold is a good value relative to other tangible things, it's not as good at determining what the general price trend will be of gold in dollar terms. So let's explore this issue of the value of the dollar relative to gold in terms of currency and reserves, and take oil out of the picture for a little while. Here is a century of data showing the debt position of the U.S. government in dollar terms, the total reported U.S. Treasury gold holdings, and the market value of those gold holdings. The Treasury debt and the market value of the gold holdings I plot against the left axis, which is logarithmic due to the strong exponential growth in both of them. The total reported Treasury gold holdings I show plotted against the arithmetic axis on the right. Let's put aside for the moment the conjecture that the Treasury doesn't have the gold that it reports to have. Whether it does or not, you'll find, will not really change the conclusions that we can draw from the data. It will only change the magnitude of the potential impact. We can see immediately a couple of very interesting features in the data. The first is that the gold held by the Treasury was very low at the beginning of the 20th century. It increased and reached a maximum around the year 1940, and then started a decline in 1960, which was halted in the 1970s. The second feature that we can see is that the debt of the U.S. as well as the value of the gold in its coffers increased exponentially over the course of the 20th century, but not at quite the same rate. Let's put a few useful markers on the chart of key dates that will allow us to draw some conclusions about gold and the dollar and their role in the monetary system. About 100 years ago, the U.S. became involved in the First World War. We were latecomers to the war. The fighting actually started a few years earlier. You can see in the chart that gold flowed into our coffers as we sold war supplies to the participants in the war, leading up to the point at which we entered. But after we entered the war, you can see that our gold holdings stopped growing, but our debt grew by quite a bit. Such is the nature of war. Of course, this wasn't the only big war that was fought in the early 20th century. World War II started in the late 30s. As was the case with World War I, we entered the war a couple of years after the fighting actually began. We can see that in the years leading up to the war, the U.S. coffers swelled with gold. Some of the increase was due to FDR's calling into the gold in the early 1930s. The rest was due to the gold flight out of Europe and into the U.S., as well as from the sale of munitions to the war participants. Once we entered the war, our stock of gold stopped growing, but our debt grew by a great deal. The Second World War ended in 1945, but it left the world with a big problem. The US had a very large percentage of the world's gold, and Europe was left in tatters. The old gold standard was abandoned, and a new system put in place with the signing of the Bretton Woods Agreement. Under this system, rather than gold being used as the ultimate settler of accounts between nations, the dollar became the world's reserve asset. This meant that other countries could sell their dollars back to the US in return for gold, but that most other currencies could not be directly exchangeable for gold. This created a huge demand for dollars, at least at first. But starting in 1957, we can see that the stock of gold in the US Treasury began to decline. The bleeding of gold out of the Treasury continued until Nixon closed the gold window in 1971. The closing of the gold window essentially meant that the dollar would no longer be exchanged directly for Treasury gold upon demand. After 1971, the gold stock in the Treasury declined a little, but for the most part it was pretty stable. Assuming, of course, that you take the Treasury's word for it that they hold the gold that they report to have. Let's give them the benefit of the doubt, just for the sake of the analysis, and continue. Now what I'd like to do is condense the data shown in the previous illustration to a single curve. This curve is simply the total US debt outstanding divided by the market value of the gold reported to be held by the Treasury. I've left some key dates on this chart as a reference. I've also listed the value of the ratio at various extremes. We will consider the significance of these values in a moment. We can see that just before our involvement in World War I, our debt floated between 5 times the gold held in the Treasury and 1.5 times the gold held in the Treasury. Gold was power money. It was the collateral that allowed the US government to borrow, and the citizens of the world only had enough confidence in the US to lend her up to 5 times the amount of gold in the Treasury. While we were involved in World War I, we borrowed heavily, and the world extended to us credit as high as slightly more than 10 times the value of the gold in our coffers. Once the war was over, we were able to recapitalize the Treasury via paying off the debt in the 20s, followed by increasing the quantity of gold in the Treasury during the 30s. Again, just prior to our involvement in World War II, we were well capitalized, and our debt-to-gold ratio fell to about 2 to 1. Our involvement in World War II resulted in us taking on very large debts, and we were extended credit to the point where it was as large as 13 times what the gold value was held in the Treasury. So if we take a look at the amount of credit the world was willing to extend the US prior to the dollar becoming the world's reserve currency, it was generally between about 2 to 10 times what the Treasury held in gold. And it's no coincidence that the ratio of gold reserves held by the Treasury was about the same fraction relative to obligations that the banking system considered prudent. Gold reserves were about 10 to 50% of total obligations. Such was the amount of trust that the rest of the world had in the United States before the establishment of the dollar as the world's reserve asset. But then we get to a point where the world monetary system changed. The US became the equivalent of a fractional reserve bank for the world. The US held gold in reserve in the Treasury, and the debt of the US, namely the dollar, became the wealth for the rest of the world. Think of the dollar as being a receipt for a deposit in a bank, and the gold being what was deposited. The Treasury of the US essentially became one big fractional reserve bank for the rest of the world. Its dollars were the equivalent to a passbook for a savings account, only the depositors were the sovereigns. We can see how the debts of the US swelled over the subsequent 25 years to the point where the ratio of debts to the Treasury holdings was as high as 33.5 times. In other words, gold, the reserve, represented only 3% of the deposits held by the rest of the world. And thanks to many foreign leaders, especially Charles de Gaulle of France, there was a run on the bank. Nixon responded by closing the gold window in 1971, which was the international equivalent to banks closing their doors during the bank runs that led up to the Great Depression. The following decade was a period of declining confidence in the US. While the amount of gold in the US Treasury didn't change much, the US debt was written down relative to gold. The mechanism that made this happen was that those who held dollars started accumulating gold on the open market. The price of gold in dollars increased until the ratio of US debt to gold held fell back to a much more reasonable 5.6. It was at this point that the gold in the U.S. Treasury was enough to cover 18% of her obligations. And it probably wouldn't have stopped there without some clever machinations from Fed Chairman Volcker and a few others, but more on that in a moment. Notice that the adjustment mechanism changed after the gold window was closed. Loss of confidence was still met with the tightening of credit relative to the gold reserve, but now it was the price of gold that changed and not the quantity of gold held in reserve. The debt was implicitly written down relative to the reserve asset via the free market. It was much like episodes in the past where the banknotes of questionable banks were sold at a discount to specie. Again, the similarities of the U.S. Treasury to a giant bank can be seen. Now, I mentioned Volcker and others halting the decline in the ratio in 1980. This was done via two mechanisms. First, interest rates were increased dramatically to the point where U.S. debt was more attractive to hold than gold. The second change that was made was the establishment of a derivatives market where paper gold could be traded. Many of the big interests actually preferred to hold the paper to actual gold, and so they started buying up paper claims on gold rather than the gold itself. This took significant pressure off of the physical gold market and resulted in a price decline of the physical metal in the early 1980s. But it also had a much more profound effect on the overall system. The derivatives market, much like the U.S. Treasury and the dollar, became a fractional reserve system pyramided atop a much smaller quantity of gold. Think of a long futures contract for gold as being like a time deposit in a bank. In other words, it functions much like a CD. You are entitled to your gold, but only after a set amount of time has passed. Look what happened between 1980 and the year 2001. The ratio of the Treasury debt to gold increased to a record value of 82 to 1. It was the effect of the pyramiding nature of the gold derivatives market that allowed the debt of the United States to only have a 1.2% gold backing. This was the peak in confidence in the dollar. It corresponded to a period of peak optimism in the U.S. as well as its financial markets. It was mostly downhill from there. Note that a period of write-offs of the U.S. debt relative to gold progressed until 2011 when the ratio reached 36 to 1. 2011 to 2014 marked a decline in the gold price at the same time the debts of the U.S. government exploded. It's not entirely clear what the cause of this spike is, but one must ask the question if it's going to continue or if it's just a correction in an ongoing trend. And so why is this such an important question? Well, it gets back to our earlier question of whether it's preferable to hold dollars or gold. If your answer to the trend question is that confidence in the U.S. and the dominance of the U.S. dollar is going to continue to increase from here, then the dollar will be a better holding than gold. In this case, we will see the expansion of debt relative to gold in the Treasury. In other words, the pyramiding atop of gold will continue and gold's value will drop. Going from a ratio of 55 to 82 would imply a pretty big increase in the dollar's purchasing power relative to gold. If, on the other hand, you believe that the rest of the world is fed up and would like to see a financial world that resembles more closely the one that we had prior to the establishment of the dollar as the world reserve asset and the U.S. Treasury the fractional reserve bank for the world, then we should expect the ratio of debt to gold to go from a pre-Bretton Woods value, or from the current value of about 50 or more, down to the pre-Bretton Woods value of less than 10. A change in the ratio from its current 55 down to 10 would require a 5.5 time upward valuation in the value of gold. So the question of whether or not gold is a good thing to hold will depend upon your vision of whether the influence of the U.S. is going to be on the increase or on the decrease in the coming decades. My guess is that it will be on the decrease, but I could be wrong. Under current circumstances, I propose taking a balanced approach and holding some gold and some dollars. If loss of confidence in the dollar is to be admitted as a possibility, then you won't want to have any less than 20% gold. That will be enough to keep you whole. If you believe, like I do, that the U.S. hegemony is on the wane, then a larger gold position is prudent.